You're watching The Morning Show on CKWS.
(7:21). Sean Binkley joins us now. And Sean, we're talking about something very timely: interest rates in Canada, legal interest rates. Of course, something many people are concerned about when they're making big purchases or even everyday life, using that credit card, for example.
Yeah, so a lot of people may not realize there's actually laws around the maximum lending rate in Canada. And so you can't just charge what you want. If something's really risky and you say, well, I'm going to charge you 300% interest for that, that's actually against the law. So everyone's heard the term loan sharking, of course, but the actual legal term for that is usury. Usury. So I've got a quick board here that shows that in the Criminal Code, Section 347 in Canada prohibits any interest rate above 60% per annum, or that's per year, the yearly interest rate. So I'm going to explain that and what that really entails, because the interest rate that you see on your loan or your mortgage document is not necessarily the effective cost of borrowing, or you might see APR listed somewhere in fine print.
Yes.
APR is the annual percentage rate, the actual cost of borrowing, the actual percentage rate. So think of what it's the real cost. So with mortgages, and I don't have an example of the mortgages, I have a really quick example of a loan, and we'll get to that in a second. But with a mortgage, if you have a $200,000 mortgage and you've got an interest rate of 2.5%, that's a low rate, of course. But if you're paying for an appraisal, that adds to the cost of that, because that's a cost of getting the loan. If you're paying for perhaps a lender fee or a broker fee on top of that, then that's going to add to the cost as well and give you a true cost of borrowing. So here's a quick example of that. On a $10,000 loan, you end up thinking, well, this is 5% interest, that's a great rate. But let's say that lender on the loan is charging you a $1,000 fee. So in fact, you're just getting $9,000 on this loan. So 1 year term, that $1,000 is 10% of the $10,000. So realistically, you're paying 15% interest on that loan. 10% is your fee, 5% is your interest rate, and the total cost is 15%. Now that's a really simple example of that.
Yes, and it shows you how it isn't as good a deal as you originally think. Now, is there wiggle room when it comes to the lender fee? Is that negotiable?
Well, you can negotiate anything, of course, but the law says, and we're talking about the law here, not what's fair, but the law says you cannot have a rate more than 60%. And the 60% is the effective cost of borrowing. So if you have a 30% loan, the whole bunch of fees, as long as it's under 60%, then it's legal. So there is one exception to that, and that's payday loans. So let's talk about payday loans. So all payday loan companies are to be registered in Ontario. They fall under the Payday Loan Act. So they have special rules, and we all see the ads. You know, $20 to borrow, $300, and some people may think that's a good deal. But let's bring up the board and show what it really costs. So here's the true interest rate for this. If you borrow $100, now the maximum under the Payday Loan Act that any payday loan company can charge is $18 during that 2-week period. So $18 to borrow $100 for 2 weeks. Not a lot of cash, right? But when you work out what that really costs you, and you have to annualize this, bottom line is that it's 468% is the interest rate. Crazy, right? Now, why can they charge so much? They're not doing credit checks. They're not reporting it to the credit bureau. There's a lot of risk associated with these loans. I'm not saying it's right, but it's legal.
They're doing this really to cover their own basis, because they're not doing the checks and they want to be able to get the money at the end of the day, right?
Yeah, that's right. And it all comes down to everything else that we've talked about, and that is when you pay people back and you keep your credit score high and you save some money, and all of these things add up the cost. So if you're riskier, it's going to cost you more money. But know your rights, know the law, and know some of those calculations.
Okay, and that was going to be my final question, Sean. We've got about a minute left. Final tips for the consumer, because we look at this, and you know, sometimes many of us need that mortgage. We need to be able to pay the lending fee. Is there any way around it? How can we get those numbers down so we're going to get the most out of our dollars?
Well, I suppose when you look at it like when you're applying for a job somewhere, if you're experienced, if you have a track record, and if you're educated, then chances are you're going to be picked over some other candidate and be paid a higher salary. So if we use that in the lending world, more people, if you have good credit, if you have stable employment, if you have a decent net worth, so you're not desperate for the money, then people are going to lend you money, be more apt to lend you money, and to lend you money at a lower cost.
Okay. All right. Great advice as always. Thank you, Sean.
Thank
See
you.
you next week. And we will see you after the break.
This Dominion Lending segment has been brought to you by Sean Binkley, broker and wealth and insurance planner.